Brijen Puri is head markets at JP Morgan. He's joining us right now. Welcome to have you. Good to have you back, Brijen, with us here on the show. Thanks very much. Prashant this side. From the last time we spoke, Brijen, global markets are starting to look a little wobbly. US markets sort of joined the global sell-off on Friday. So you've got a situation that global growth expectations have generally picked up. Reported numbers for the last quarter in the US, I mean, that came in much higher than expectations. But, risk assets like equities are starting to look weakish. So that correlation, that positive correlation of strong underlying growth and rising equity prices, I mean, that kind of seems to have broken down. Would you agree with that assessment?
Yeah, I guess, good morning. I guess the markets have caught a bit of the flu, which is there in the air all around. Like you mentioned, it's a bit of a fear around the growth issues in the developed markets, and more importantly, the inflationary pressures, because that is what is really worrying the market in terms of the Fed reaction function to the inflation numbers and the wage growth, which is where the NFP numbers and the unemployment and wage data on Friday was a bit of a breather, but still we are not out of the woods really from an emerging market perspective, because it's not a matter of if, but it's a matter of when the Fed starts tightening. And really the market reaction over the past few weeks has been a reminder as to the work that we need to do. Admittedly, India specifically in the emerging market basket has done a lot of good work. There is tremendous policy credibility both with the government as well as the RBI, which has gone down well. We've controlled to an extent the current account as well as the fiscal deficit, which is a huge positive from the last time we were in a situation where the markets were fearing what the Fed would do. We have the ECB, which is probably on a slightly easier stance than where it was earlier. So while the impact of Fed tightening would probably be a little less on India, but India would not escape some of that. And like you mentioned, across the world, equities which have had a very good run over the past couple of months really are looking ripe for a potential correction. The thought in the market really is that is it going to be a correction which is healthy in the medium-term bull run, should that develop, or is it more of a reversal? That question remains out there. My personal view is that we'll probably consolidate across asset classes. People will take a relook as to what their portfolios are, will want to be very sure of what asset classes they are in. Within that, India does look good. Like I said earlier, it will be impacted, but hopefully not as much as it was earlier. The RBI has a lot more ammunition now.
We'll get to the local stuff in just a bit, but I just wanted to come in and just get your view on this, global thing. So, if you look at the history in emerging market equities have done well. When yields in the US are actually rising, not falling, as one would generally believe. So growth, when growth picks up, the US growth picks up, it does well, the economy does well, other markets also do well. I mean, that's essentially what I'm saying. You've got a situation over the last couple of years when growth was way below par in the US. The Fed did something unprecedented, pump all this money. Markets nevertheless continue to rally. I mean, without the US economy picking up, we are at all-time highs, right? So are other markets. So as growth starts to pick up there and interest rates are increased, do you think that, and yields also start to rise, do you think we will continue to rise and do very well? Which basically means that there is no consequence for all this printing which has gone on for now 5 years or so. Is that the way to look at things? Or do you think as growth picks up, interest rates rise, it will hurt us? I mean, by us, I mean India, emerging markets, etc.
So I think we need to parse a little bit of where the growth in the US is coming from. So if we are seeing what's happening in the US each time that that we see fears of a Fed tightening, we've almost seen a cyclical function where we've seen growth, employment, and confidence numbers take a hit. So really, it's a very fine balance for the Fed. While the Fed is continuing with its accommodative stance, we are seeing the markets do fairly okay, growth do fine. However, as soon as there are fears about Fed tapering, we see that growth come off a bit. What has changed over the past couple of months as compared to the earlier few quarters is that we are seeing signs of inflation in the US, which really leaves the US kind of in a situation where India was some time back and is hopefully exiting, which is basically growth which is not necessarily self-instituting and therefore requires the Federal Reserve to continue with its stimulus. However, with inflation eventually catching up. So that really is the fear which the markets have. And given this trade-off, my personal take is that the Fed will probably not find it very easy to raise rates very fast. Eventually, yes, global rates would have to rise. If that rate rise is happening on account of global growth, with emerging markets and especially India being a lot more correlated to global demand, we should see some of the positive impact of that. However, the flip side would be felt on capital. Net, it's going to be a fine line, but if global growth picks up, unless it is really chugging along at a very fast pace, requiring the Fed to increase rates very fast, if it's a gradual increase, it should actually bode fairly okay for India, which will grow. The markets, of course, will not have the same pace of appreciation that we've been used to over the past 3 to 6 months. That is when really the policy decisions which are taken in India will come to the fore, whether we are able to deliver on the promises which the market is discounting today.
Right, Brijen, this is Anandya from the Delhi studio. I just want to go back to that point you made, that whenever the Fed kind of threatens, I would say, to tighten liquidity, you see growth cooling off in the US. What does that indicate? That we've actually not come out of anything other than a credit-driven growth bubble? Every time there's credit, you'll see consumption and productive consumption go up. But if credit is held back, then it will not happen.
I think it's there is some amount of that. The more important part is the way employment, rather unemployment, is structured in the US, where we are seeing some issues around the structural unemployment and really the inability to get all the people who have moved out from the employment ambit back into the job scene, which is creating a kind of a conundrum where on one side you have more people who are unemployed, and on the other side you're seeing some parts of the labor market where jobs are actually getting tighter. So that really is the cause for the underlying wage inflation and the inflation fears which the Fed has, which is where I think this problem is, where we are seeing growth which is not necessarily completely on solid grounds, but inflation picking up alongside.
So I'd again repeat that question, because even if you look at wages going up at a time when there's otherwise structural unemployment, high unemployment, people are actually not even registering to go to work, is that again a sign that they're getting credit to consume? That is it back to a situation where they're getting credit or some sort of governmental support to be able to consume, and that is what is driving consumption once again? I mean, I'll take a parallel in India where, it's
actually a combination of both.
I'll take a parallel in India where a Manrega was said to have created a base wage level in agricultural labor, and therefore a base wage level. But at the same time, there was no there was pretty high unemployment?
So, the US does not necessarily have the equivalent of an umbrella, though they do have the job security. But coming to your question, it's really a combination of both, because there is an element to the fact that credit is what is driving some of the growth. However, I think the tightening jobs seen in some of the sectors is also boding towards the fact that there is some real growth which is taking place where people are requiring more jobs. So if we roll back a couple of years immediately after the financial crisis, while we did see a spurt in government-induced growth world over, we were not seeing the same employment numbers. Today, that is being buffeted by employment numbers, albeit in some narrow sectors to start off with.
So, Brijen, would you say that if the Fed decides to tighten, then we will see a significant decline in US growth almost immediately?
It will definitely impact US growth because, like we just discussed, it's a combination of a credit-driven as well as an underlying growth economy, which is where I guess most economists estimate is that when the Fed does start to increase rates, it would probably be a lot more gradual. It will not necessarily be a very quick increase, because if it were to do that, it would risk the US falling back into a recession, which really would be the worst case scenario as of now.
So if let's say I were a fund in the US and I saw that interest rates have got tightened. Now, the problem with that, on the other hand, is that if growth tapers off, then the equity markets in the home country, which is US, will also cool off. We're already seeing signs of, in terms of technical analysts saying that the cooling off period has started. Now, what would I do with my money? Would I sit on cash, invest in debt, or would I have a chance to actually go into emerging markets, which are still showing some sort of resilience in terms of growth?
See, which is where the pace of degrowth would be very important, because if it is a mild, if it's an economy which is in a stop-start mode in the US, that really is the ideal case for most emerging markets, because it's not a risk-off scenario. You are seeing continued stimulus by the Fed, given a global scenario which is not very bad. You have growth which is probably in the 1s and 2s and 3s in the US, or closer to the 1s and 2s in the US. That is when emerging markets would tend to do well. That really is the sweet spot. If we were to see a situation where maybe on account of a Fed tightening very fast or any other factor, the US economy were to shrink materially, that is when the markets would really go into more of a risk-off mode, and there would be a flight to quality. In that scenario, the emerging market universe would actually tend to perform worse than the developed market, because people would be looking for quality assets going back towards US treasuries. So which is where the pace of degrowth is what is, and the pace of the bad news in the US is what would decide whether it is positive or otherwise for emerging markets.
So would it be correct to say that your gut feel is that this pace is going to be slow?
Yes. I would think that the Fed policies, while they have their critics and they obviously have had spillover effects, not only globally but within the US market also in terms of capital allocation especially, they have had the positive effects. We are seeing signs of organic growth picking up within the US, albeit a little more slowly as compared to what the numbers show. So that will ensure that this pace should continue, and whatever happens with the Fed, it will be a gradual tightening.
So is there a case to say that since the tightening is likely to be gradual, that we will see some kind of easing off in the Indian money markets? Are interest rates likely to go down in India?
See, I think the Indian interest rates, while it would depend on what happens globally, but at the moment, they are a lot more dependent on what's happening in India, namely the inflation versus growth argument. Given the credibility which both government and RBI have managed to build up, I think they will be loath to give that up very easily. And therefore, unless we see signs of inflationary pressures really coming off in India, it will not be easy for the RBI to reduce rates, and it really would not actually be wise also for them to reduce interest rates immediately. Therefore, I think unless, rather, till we see more clarity on the impact of the monsoons, or rather, first, what's the monsoon distribution going to be in August, what's going to be the impact on food prices, and therefore on inflation, where do we see inflation and inflationary expectations play out in the medium term? Do we see, while we are pretty much on target to meet the RBI's 8% goal by Jan or Q1 2015, the 6% goal for the subsequent year is something which is still up in the air, and as of now, monsoons could play a spoiled sport for that. So up until there's clarity, which I think means that at least through the rest of this calendar year, we don't see any easing from the RBI, though the RBI would be watching all factors. If things go well as planned, then probably a Q1 2015, calendar 15 is when we can expect the RBI to ease at its earliest if it happens.
Would it be fair to also say that means that other than those who will be able to raise money from the markets, capital expenditure broadly in the Indian manufacturing sector is going to be delayed at least till Q1 calendar year 15?
You know, there have been various studies, and really the capital expenditure is not necessarily stuck up because of interest rates. You know, there was one particular study which we ourselves had published, our economists had done, which showed that it's only around 40% of the slowdown in capital expenditure could be attributed to interest rates. The rest of it, and the more immediate impact, is of bureaucratic hurdles, confidence in the political setup, and getting clearances going. So if the government starts delivering on the clearances and the ease of business, that itself should provide a fillip to the capital expenditure, and the interest rate could really follow, because 25 basis points here or there does not really make as much of a difference to the viability as against just the visibility of being able to complete the project in time, get clearances in time, and therefore be able to move into production in time.
So if one had to look at the broad India story, and for someone sitting outside India, what would be the key highlights that you would point out? That these are the areas where it's worth investing in, these are the risks.
So I think over the past few months, it's really gone very well for India. The foreign investors that we speak to are very enthused about what's happening. They're very happy with the realization, both at the center, that fiscal is a very important factor. Foreign investment cannot necessarily be taken for granted and will only come when economic fundamentals are strong. We've been helped globally as compared to middle of last year versus now, when you know, the fears around the Fed tightening have also eased a bit, given us some room. In the interim, we've managed to build up sizable reserves, which really ensures us against a repeat of last year when rupee depreciated materially. The central bank is on the ball both on inflation as well as the negative consequences of letting rupee completely float freely in times of global stress. So all of that has worked well. The government has made the right noises in terms of what they want to do on reform. So what the foreign investors today are looking for is, they've already had a kind of, for lack of a better word, India re-rating in their minds based on expectation. Now it's about delivery. So, some of the small things which the government is doing, namely around labor reforms and land reforms and ease of investment, all of that and the implementation of that is what investors would look to really increase their allocation beyond what they already have in India. So up until then, it's probably a wait and watch with a positive bias.
Specifically right now that foreign investors would be attracted to, any specific sector? Because you're saying that the overall situation has to be watched.
Yes, yes. So, I don't track the equity markets as closely, so would not be able to comment on sector-specific issues. But in general, yes. And I think the other important major event which is coming up is the elections later this year, because that could really be viewed as a referendum on the government and its policies thus far. So it's important for the government to do well. If we see a positive result for the ruling coalition in those state elections, then that could be another catalyst going forward.
Okay, thank you so much for joining us.